Good morning, good afternoon, good evening, and welcome, depending where you are on the planets. And yeah, hi there. Welcome to another Monday morning, 28th March 2022, Bull versus Bear webinar for Trade Day. Steve Miley on the call. Welcome, everyone. Start of a new week in here. I'm going to go and run through what, as we usually do in here on a daily basis, but also on a Monday to do that bigger look at the week, run through the data for the week in here, what's coming up. It's kind of quite a lot to get through. So I might just skip ahead of some of this stuff. A lot of the stuff, I don't want to just repeating stuff that I've gone through on other webinars, just focusing on the kind of new stuff in here. So you can get this. We put this out. I put this out at the weekend, every weekend. So it's the, kind of recap and outlook in here. For markets, what's been going on a macro fundamental basis and what we've got coming up and how it's impacted markets. If you go to the trading room, go into the trading room and you can pick that up there under where the financial market reports are, where you see my technical analysis, the daily technical analysis reports. It's in there. It's labeled up as weekly recap and update, and it's got the date in there as well. So you can go and have a look at it there. So just looking back, I think there's been less of an emphasis. We're seeing less and less an emphasis on the conflict. No major escalations. If anything, what we're seeing is Russian troops being suffering setbacks in here at the moment. No update on the talks at the moment. Still hopes on the talks in here, but no real updates. But all this is taking us back to risk on. We've had the rate hike from the Fed, and then even then last week, adding on to that, Powell's hinting at a 50 basis point and 0.5% rate rise at the next meeting. And we've been looking at, go back to the CME tool that shows us in here. Look, CME tool still signaling now up to a 70% chance. You're nailed on for 25 and a 70% chance pretty much of a 50 basis points. So even though all this hawkishness is out there, the markets are kind of discounted down. And if anything, I think now markets are, as long as the Fed and other central banks don't become too hawkish, too aggressively hawkish, the markets are just taking it in their stride and saying, yeah, we know you're going to be more hawkish. You have to be more hawkish. So the market's kind of taking it in stride. So less of a focus on Russia-Ukraine. And if we don't get any escalation, I'd see that continuing to be the case. And then also less of a focus on, the hawkishness of the Fed. If anything, the hawkishness, as long as they stay on this path, the markets, when I keep saying the markets, I'm meaning the stock markets. The equity markets have built that in. The bond markets, though, are very, very, very fearful of, they're kind of built in, I think, the increased rate hikes, but they're fearful of spiraling inflation, and we're seeing increased emphasis on higher yields, across global bond markets and the US bond markets. And if I just go and skip to the this morning in here, look, you can see the markets actually has rebounded, but this is the Treasury bonds. Treasury bonds have been on this massive sell-off, hardly a respite from that sell-off, and big move lower at the end of last week. So remember, this is lower bond prices. This is 10-year notes, lower bond prices, higher bond yields, and we went even significantly lower. But we have actually rebounded in here, some respite. This could be, if we end up where we are today or even higher in bond prices, this could be a short-term base in yields, and that would actually even probably be a short-term bottom in prices, a short-term top in yields. And that could actually be a positive for the stock indices. If we see bond prices start to move just back slightly high, I'm not expecting this to go back up here, guys. I'm not turning all bullish on this, but this is a very overstretched trade. This has become a very, very crowded trade. It's been going on right from the beginning of March in here, and it's become a very crowded trade. Fast money. When I say fast money, we're talking hedge funds, hedge funds in here, commodity trading accounts. We're seeing fast money shorts of the bond market, and so we're seeing that's become a crowded trade. We could easily get a short squeeze on this back up into this area up here. So going to higher prices, lower yields, and that would actually probably give the equity market some upside, because it's just taking some of the upward pressure that you get from higher yield. The higher yield pressure is kind of negative for stocks, if anything. So so I think that is a real risk in here, that we do get some kind of rebound. So watch this today, watching the bond market. If you're not trading the bond market, you're trading stocks, stock indices, watching out for this, because if this starts to track high, I think it could be beneficial for stocks in here. So watching out for that. Well, let's go back to the program. So yeah, but inflation has been a worry. Inflation and the threat of stagflation. And talking about the threat of stagflation, so this morning on the wires, is what it's saying. We'll come to when we look at the calendar again. But the governor of the Bank of England, Bailey, in here, we are starting to see evidence of a growth slowdown. This is what they're worried about, right? Inflationary pressures still coming through, and look. But he said, look, there are risks on both sides to inflation, and they're starting to see very large trade-off between inflation and output. So real concerns, okay, of a potential for stagflation here, and they're starting to see evidence of a slowdown from Bank of England Bailey in here this morning, and he was one of the speakers we had today. We'll come back to the calendar. We'll look at the calendar shortly. Also over the weekend, Biden finished off his tour of Europe. Kind of, you would argue, maybe put his foot in it slightly with comments about this guy that shouldn't be in power. Went off script, ad-libbed at the end of his speech. Really good up to then. Everything's been really, really super positive. Kind of put his foot in it. Been a lot of backtracking from Biden, from his advisors. And so, yeah, I mean, trying to, backtrack on what was said there. It didn't really have a negative impact on, significantly negative impact on the stocks. That could have had a significantly negative on stocks, inflaming the situation with Russia, but it didn't have a significant impact on stocks. Right. And let's wind forward to what we're kind of watching into this week then. So I said already, Bailey is speaking today. That's the only thing of real note, and we've already had that. Australian retail sales markets you guys are trading, probably not going to have a big impact, unless obviously if you're trading FX and you're trading the Australian dollar. Through the week, German CPI, we're going to be watching that, right? CPI neighbor inflation data's one of the world's largest economies in here. Certainly going to see if there's inflationary pressures coming through in Germany. Then we get the US ADP employment change. Remember, this is the front runner. This is the forerunner of the unemployment report, which we get at the end of the week on Friday. We also get US GDP and PCE. PCE is released over 2 days. I'm not actually quite sure why they do this, but they do it. PCE is personal consumption expenditure data. You get kind of the month-to-month, quarter-on-quarter, and year-on-year split between the 2 days. Not 100% sure why that happens, but it is the case. Why is that important? PCE, personal consumption expenditure, the prices paid part. The Fed tells us that's what their preferred measure of inflation. Now, even though CPI grabs all the headlines, even though the market still moves more aggressively on the CPI data, the consumer price index, nevertheless, the Fed tell us this is their preferred measure. So we certainly should be watching that. So those comes on Wednesday and again on Thursday for the PCE data. For Thursday, we get UK GDP, German retail sales, and German unemployment rates. Probably not impacting too much on the markets you guys are following. Nevertheless, that can have an impact on the stock indices in Europe, on the FTSE 100 and the DAX, the German DAX index, and then that can have a knock-on effect, obviously, onto the US equity indices. We also get the OPEC. I've actually got OPEC there. It's actually OPEC Plus meeting. OPEC Plus meeting is on Thursday as well. Be interesting to see if they turn the taps on to try and get the oil price down. Okay. So, but they have got limited capacity at the moment. So it'd be interesting to see if anything comes from that OPEC Plus meeting. And then a big day to end the week. So we get the global market and US ISM PMI data. So we get the PMI data from across the globe and the US ISM data. I'm going to double check, but I'm pretty sure those are, if I go to the calendar, just go to this week. I'm pretty sure it's the manufacturing data. I didn't put it there. Should have put that in there. I think it's the manufacturing data. Yeah, manufacturing data always comes first. So I just wanted to double check that. So it's the manufacturing data in here from market and from the ISM, okay, the Institute of Supply Management in the US, and then the always much watch, even though it's less relevant at the moment. The employment report less relevant. Why? Because we know we're pretty much working at a very tight labor market. We're at full capacity. The market is all focused on inflationary pressures, right? So, but it'd be interesting. What the market won't want to see is to see unemployment to start to rise aggressively. If we see that, then it could be a sign of a slowdown. But we're not looking for that at all. In fact, if anything, if I go back to the calendar in here and we go for the unemployment report in here, where are we? NFP. We're looking to add in another 475,000 jobs. Okay. So what you want to do, you don't want to see a massive miss on that, right? If it's down anywhere, sub 200,000, that would be maybe a signs that the economy is starting to slow quickly because of concerns around a slowdown because of what Ukraine, because of inflationary pressures. Okay, I'm not expecting that, but watching out for that. We're going to watch it because it's the most watched piece of data, and it has been for decades and decades. It's certainly since I've been in the market, it's always been the most important piece of data, this most watched piece of data anyway. Okay. So that's kind of covering off what we've got coming up for the whole week in here. I want to flag this up. This is down the line. It's not anywhere near now. And I know we're day trading at trade day, but it's something on the horizon. Earnings season is going to be really, really interesting. Okay. Is everything we've seen in the last quarter, the fact that we've had in the last quarter, remember, it's been such a busy world, really, from a macroeconomic geopolitical standpoint. We've had a war break out in Europe. Okay. We've had the Fed increase interest rate for the first time in multiple years. Okay, we've had the Fed not only increase interest rates, but shift to far more hawkish than markets expected throughout the whole of the first quarter. We've also had the Bank of England raise interest rates. It had the signal they may start to increase interest rates, right? The world's major central banks. So all of this, is going to change things around the globe for major corporates. So it'd be really interesting to see as we go into earnings season. Now, we're not in earnings seasons anywhere near yet. If you look, we've got Walgreen Boots in here reporting towards the end of this week on Thursday. But if we start to move forward into the week after, again, I've done a filter on this. I've only got the US, and I've also on the filter in here. You can filter in here, okay? And this is on investing.com, by the way. But and I've ticked three stars in here. I only want to see the big names in here. Why do I only want to see the big names? Because really, I'm looking at it as going to impact on the indices. So this week's light, and next week's fairly light, though. But if we go into the week after, in that, so it's going to be the week commencing, what is that, the 11th, I think. This is where we should kick off in earnest. And there we go. That's where we kick off in earnest. So it's still a couple of weeks away, right? But Wednesday of that week, Wednesday the 13th of April, it's still some way away yet. But nevertheless, that's when we kick off with the financials, okay? Wednesday on Thursday of that week. So it's just something out there on the horizon, something to be aware of going forward, guys, okay? Right, let's have a look at what's going on macro fundamentals in here. Well, Biden, Putin, obviously Biden denied he's seeking the removal of backtracking on the comments he made in here. People trying to distance themselves from those comments in Europe, okay? We've also got, Ukrainian and Russian negotiating teams planning to meet in Turkey this week. Headline here, though, out of Russia said there's been no such spatial breakthrough with talks in Ukraine. That comes out of the Kremlin. Talks will be held Turkey this week, but unlikely to begin today. Talks may start tomorrow. So nothing going on that front at the moment. Talks may start tomorrow. So we're not expecting anything in the very short term on the talk side of things. Where are we in here? Let me just close some of these tabs down so then I can focus on what we've got in here. So 5 things. So bonds, we've already spoken about this. They had a massive sell-off in Heather. Trevor's had this bad quarter ever. It's the worst quarter in movement of Treasury bonds ever as a sell-off. Okay, 6.5% down so far this year in Q1. Not been seen for data going back to 1973, according to Bloomberg. Okay, and we saw a move later today down lower, but obviously move back higher. I don't know why this gets mentioned, but it obviously does. So. I'm sure you've seen what Will Smith did at the Oscars. We'll park that there. It's nothing to do with what we're looking at. So stocks up, bonds down. Okay. And we've got I think they've screwed up in here. Look, last thing, Mark also just wanted to experiment with fewer links just from a speed perspective. I think Bloomberg have screwed up there. So if we go and take a look at where we are in markets at the moment. So European stocks are up. Now these are kind of a little bit flattering, these numbers, okay? And I just want to do a little bit of, it's not really education, but it's a little bit of a heads up for you guys. So European stock indices, so these are the cash markets, These are not the futures. These are on the cash markets. Now, the cash markets locally in Europe close around, anywhere between, and I don't know the close of every single stock index in Europe, right? But they close around between, say, 4 p.m. and 6 p.m. local time, okay? And that is going to be, if you think US time, that's going to be anywhere, and I'm going to do Eastern time just for ease, okay? That's going to be anywhere between 11 a.m. Eastern and maybe 1 p.m. Eastern, okay? Maybe out to 2 p.m. Eastern, okay? That's when we're getting the stock indices closed. Now, obviously, you've still got a few more hours of trading on Wall Street, okay? So Wall Street's still open for a few more hours. So if you think about it, back on Friday, we had a really strong, fairly late close, rally. Markets, obviously, we had the time difference. One thing on the time difference as well, if you're in Europe, obviously, the webinar's back to where it was. If you've been in the US, you've not noticed any difference. But we've had to move the webinar forward an hour now, but it's got more back an hour. So we're back at UK time, British summer time now. It's 12:30. 12:30. Okay, 12:30 British summer time, 1:30 if you're on Central Time in Europe. Okay, so just a little heads up on that one. But yeah, so what I was saying there was basically markets close earlier in Europe than they do in the US, and it's particularly noticeable when you see it on a Friday. You haven't got the stock index futures. Okay, so the markets closed, and then obviously US markets continued high at a really strong close, rallied in the last few hours of trading. So we're noticeably up there. But remember, these are playing catch up. These are playing catch up for the late rally that we saw in the US on Friday. So some of this percentage up. So you can see we're up, most places we're up over 1%, 1 to 1.5% higher. If you go and take a look at the European stocks in here, so US stocks, so they were up, about 0.5% at the end of the day. And we're unchanged. Okay, we're actually lower in here earlier on today. These are actually down with European stock indexes. These are the futures, remember. Okay, these are the futures. Okay, so the futures are pretty much unchanged going into the opens today. But what you have to remember is we had the US stocks indices opened later, so European stocks are up higher because of the extra few hours that were trading, and that was a strong few hours that saw the S&P and the Dow rally into the closes and put up those 0.5% gains in here pretty much at the end of the day on Friday. So European stock indices playing catch up, and that's why they're up so much today. Also, there has been a bit of outperformance in here so far by the looks of it, because they've added on more than that as well. I'm not quite sure 100% why Europe's particularly outperformed today, but it seems that it has so far. Obviously, the cash market in the US still to open yet, but yeah, we're looking for pretty much unchanged. But remember, these markets have been lower in here already today and have rebounded. Right, a couple of little articles, things I just want to draw your attention to outside of this. So bonds flash growth warning as global stocks mixed. Okay, so bonds significantly lower in here. We spoke to that, but they have gone lower and rebounded. So just bonds concerned about the growth in here. And again, look, global bond rout deepens on fear rate hikes will stoke recession. So concerns that the Fed rate hikes and global rate hikes in here are going to be a problem. And this is really interesting. Bank of Japan stepped in twice today to cap 10-year yields at 0.25%. So the Bank of Japan came in, Japanese government bonds, JGBs, were selling off. The 10 years were selling off. They're trying to keep them at a yield sub 0.25%. So they stepped in and bought, and they had to step in and buy them twice in here. And actually, at one point, they did flash through 0.25. They couldn't even keep them there, even though it was the Bank of Japan buying. Okay, so Bank of Japan stepping in to keep yields below or at or below the 0.25% level in the 10 years. Okay, so price spike raising expectations of even more aggressive rate hikes, and that's what we're seeing. And we did get one part of the curve in here. They're mentioning it here. Remember, we've said, Powell told us, look at the 3 month to 18-month part of the curve. A lot of the time people are looking at 2s to 10s. Now, we did get an inversion today. Okay, Treasury Silver money in a key portion of the US curve inverted for the first time since 2006. Okay, and obviously post 2006, then we had the global financial crisis. I'm pretty sure it was 5s, 10s. Where is it? It doesn't actually say it. It just says a significant part, and it doesn't go on to tell you what it is. I've read this earlier on today. It was 5s. Sorry, not 5s. 530s. The 530 part of the US Treasury curve inverted this morning. Okay, and then last time it inverted was 2006. Within a couple of years, we had recession, right, because of the global financial crisis. So it's not always, doesn't always work. Okay, but it is. It has been a particular. Oh, here it is. Okay, here we go. Yields on 2 years as much as 40 basis points to 2.41. So yields on 2-year treasuries surged 14 pips this morning, okay, to lead increases across global trades priced in 2 full percentage points of Fed increase over the remainder of this year. Yields on 5-year notes rose above those on 30-year bonds. Okay, so that's the inversion. Okay, so it was the 5s, 30s. Okay, so just give you a heads up on that. And again, Reuters covering the same thing in here. Well, that's what the headline did say. Didn't actually come up. But bonds take a fresh beating in here. That should be what the headline is. So bonds lower. And then the other thing with bonds going lower in price, higher in yields. Again, they've not got the headlines. Terrible job in here by Reuters. But this headline was yen plumbs 6-year. So you can see the headline there up the top. Yen plumbs 6-year low. So dollar yen is surging higher. The yen's going lower to another 6-year low in here. And then that's because of the interest rate differential. I spoke about this last week. The Fed are hiking rates. We've been at zero rate policy in Japan for over 20 years. Japanese rates are not going anywhere. They're trying to keep them, we just said they're the 10-year below. So as you get that rate differential, the widening of interest rate differentials between the US and Japan, then obviously the Japanese yen is going to be less attractive to invest in Japan because of the relatively lower yields. That, alongside the fact we've got high oil prices equals, remember, a negative for Japan because they're a net importer of oil. Okay, and also we're shifting back towards risk on. Remember, risk on Japanese yen is seen as a safe haven, so we've certainly shifted back towards risk on. Risk on, remember, with the equity markets going higher. Okay, right. Let's take a look at a few charts and I'm going to wrap us up. We've already looked at this. This is going to be really interesting and worth monitoring. If this starts to push higher, the treasuries in here, certainly you're going to potentially see in here. And let's have a look. Let's zoom in on a 1 hour chart in here. Looks like a little bit of a base forming, right? So there's an impulsive move in here. We saw on Friday lower and then significantly lower again in here this morning. Got all of that back in here from this morning. So if we can get above that high there, now this is on Treasury futures on the June contract. The high there, 121.29.5. Above there will signal a little basing pattern and open up some upside. So watching out for that. Maybe stick an alert, guys, to watch out for a move above there. Let's take a look at the equity indices. S&P dipped and rebounded already this morning, nudging higher in here. So we were down on the day at one point in here today. Got back those losses, higher again in here today. Look, zoning in on these highs. You remember we had these in our crosshairs back on Friday. These string of highs up at 45.76, 45.78, 45.78 again, and over here 45.84. So these will be my targets for today, minimum targets. If you break those, you probably get a little impulsive push through there. And if we step in on the S&P, I've got the 5-minute chart in here, but you can see basically on our highs in here on the 5-minute chart, just dipping back lower right now. But if I just zoom back out to like a 30-minute, super strong, look at that trend line, how well that worked as well. Okay, so the trend line drawn off of here, ignoring this low here, through here, rebounds in here. It's a really strong trend line. Don't think it goes this back further, does it? Don't think so. No. So yeah, I mean, for me, all real risk to the upside still. And obviously we're just having this little dip at the moment. Maybe, I don't think it's too late to get in either. We're not much up on the day. So there's real further upside potential going into the day. NASDAQ, kind of same story, not quite as positive in here, but we have dipped and rebounded. Dip and a rebound for a resilient close on Friday. So we kind of worked off the overbought condition a little bit in here, a little bit overbought down here on the daily, worked that off a little bit in here, and the market pointing higher. We're flirting with this 50% retracement of the whole sell-off. That 50% retracement, we're sitting right on that around 14,800. Real risk up to these peaks here, and maybe even to this peak up here and this high up and this retracement level. So the peak here, this swing high target 15,070. 15,070 potentially up there today. Certainly risk up to 15,000, 15,070. Maybe overshoot risk towards this level in the next couple of days. And again, stepping in onto, got 5-minute, but I'm going to step out in here to 30-minute. I can't argue with that really. Got counter trend line. Counter trend line comes through here. We've broken the counter trend line above this peak as well. Now just aiming back at Friday's peak now. So yeah, all risk to the upside for me there as well. Let's have a quick little run through on commodities and where we're at. So first of all, we're actually going to start off with oil. There's the daily. Notable sell-off in here today. Remember, we've got OPEC coming up. Not quite sure why that's selling off in here. Not really seen any real reason for that. But notable sell-off in here today for oil already. And stepping in, I've got it on 5 minutes, so I'll flip it out to 30 first of all. Yeah, this looks like a bigger. We were talking about, being a bit more bearish on this. It did actually go back above these down trend lines, but look, given that back up again, you got now bigger. You got lower lows and lower highs through this session. Then it kind of blew that out back on with Friday's rebound above here. But then look, given all that back now, back through these lows, so you got a bigger lower lows and lower highs, and accelerated lower in the last hour or so. Look, sitting right on this low in here. Look, this important swing low. You could argue you got, we said before about this being head and shoulder. Look at this head, shoulder, yeah. And we've kind of already broken the neckline to this kind of head in here, kind of flirted with it here, breaking through here, kind of flirted with it here, and then impulsively down through here. This is the other sort of side of the shoulder in here. That low there is 107.10. Through 107.10, you could really, no, that might be wrong. Hold on 1 second. Is that right? I think that's right. 107.10. Through 107.10, you can see another acceleration lower. So watching out for that on oil. 107.10. If that goes lower again, obviously that's going to help stocks again on the top side, right? Let's have another look at oil. Sorry, and now look at gold. Gold down lower again, probably risk on. Maybe the dollar move also helping. Dollar yen up. Dollar strength, stronger dollar, weaker yen in here, and stronger dollar, negative for gold. And so that looks kind of negative, having been fairly positive. It looked like broken out of this little range it was in, back into that range in there. Trouble is in here, do you want to sell it without having already moved that much? 30-minute chart, it's been very impulsive. It's kind of consolidating. I think, I couldn't, I mean, if it breaks below the low, I'd go with that. If it breaks above these little peaks in here, it looks like a little bottom. It could retrace into here. No strong view again there on gold. All right, guys, I'm going to wrap it up. There's been a lot in there. I hope that was useful. Please do ask questions. I know a lot of you guys watch this on the recording and don't watch it live. If you are live, please feel free to ask questions. Also, fire some questions in. If you've got some questions, you want something covered in the webinar, right? It's a good way to get something covered. It helps you out, maybe helps out some of your fellow traders. If you want something covered in the webinar, throw it in one of the forums, one of the chats. We're monitoring those all the time. Throw it in one of the forums or ping us a direct email to Trade Day, support at Trade Day, and we will address it in the webinars. So, it gets us a bit more interactive with you guys. So, yeah, feel free to do that. Yeah, so if anything in the forums, anything you want to look at on the webinars, throw it into one of the forums. We'll find it. Don't worry, particularly, obviously try and pick a relevant forum, but we'll find it, and then we can react to anything you guys want to do. Okay. All right, I'm going to wrap it there. I'm going to wish you all a great trading day. Stay safe, and I'll be back with you again with a bull versus bear webinar on Tuesday. Till then, bye.